Hey Grayson, how are you?
Good, Andrew. How are you?
I'm doing well. It's great to have you back on the podcast. There's a few things I want to make sure that we cover today, but let's start with the last time that we had you on the podcast, which was actually way back in September of 2024. And we talked about some of the volatility that comes along with election years in the US and how you manage through those cycles. We fast forward now about 6 months, and here we are today where I guess the volatility from the election looks rather quaint in comparison to what we're experiencing in the markets, the economy, and really the world today. So the election's over. We have a new administration in place, and we're seeing those policy shifts in action. How are you and the team processing those changes, and what's been the market's reaction so far?
It's been a tough market. People were pretty excited at first, and then it's really taken a U-turn lately. Some people are calling it the shift from the Trump bump to the Trump dump. So it's been kind of tough. And as you look at the S&P 500, for example, we're now significantly below where we were on election day, and also kind of back to mid-September levels where people were starting to kind of foresee that Trump might be the president of the U.S. So the market's kind of really cooled. And if you look at Trump's sidekick Musk, or maybe Musk's sidekick is Trump, the other way around, but shares of Tesla, which are kind of a good proxy of some of the stocks that have been impacted by the government, they've done the same thing. They've had a real volatile move up and then back down again to below pre-election levels. So what we've seen is post-election, there are really kind of targeted sectors that people started to worry about. Things like R.F. Kennedy's appointment hurting vaccines and drug-related stocks and scientific research. And then you kind of saw that move over to Doge and some of the cuts that Musk has been pushing, hurting many different industries, but some life science companies, government jobs for sure, consulting, defense jobs. And so it's kind of moved from kind of one-off sectors where those have gotten hit pretty badly in cases, and we've seen it just like one after another. And so I think the shift now that we're seeing, and perhaps why the market's becoming a bit more volatile, is that they're just viewing it as being more widespread. So it seems like the thinking pattern is, oh, these are just some one-off sectors, not great for that, but the rest of the economy is doing great. To now, this is becoming a bit more widespread. We can't really shrug it off anymore. And so you're seeing a lot more industries impacted, kind of intentionally and unintentionally in some cases. You're seeing spikes in volatility like the VIX that I'm sure you're aware of, but kind of a popular measure of volatility. That's really spiked up now to the high 20s, where it was down in the low teens before. And, we're kind of at a level that you don't hit that often. We've hit it several times in the past 5 years. It was above that during COVID, but doesn't get above that level too many times. So we're seeing inflation worries, of course. So we've seen government yields go back up to the 4% range for the 10-year yield, for example, which impacts mortgage costs, credit card borrowing costs. Inflation's impacting a lot of things like food costs, gasoline costs, and all of that. And lately you've seen, just worries crawl in different parts of the economy. Recently you saw Delta Airlines take down their numbers, which I think is just an indication that, people are a little more worried about things. They don't want to travel. They don't want to book big flights or vacations like they did the last few years. Now they want to just kind of hold on to that cash and see what happens. So the negative policy shifts, the impact is spreading. One thing to think about is just the resilience of the economy. I think there's been a bit of a shift there too, and specifically the resilience of the stock market. If you look over the past decade, for example, you've seen a pretty big increase in the amount of passive investing. So that was, around 30% of the market a decade ago, and now it's just over half the market is passive. And that tends to be more momentum driven. So as the economy goes up, people put money into passive funds. Those funds just buy the same stocks that kind of are going up and push them up more. And then people get, as it's just self-fulfilling. So people say, this is exciting. Let's keep buying this stuff. And it keeps pushing it up. So we'll see what happens too. It's great on the way up for a lot of these, especially big stocks that are in the indices. But the same thing can happen on the way down. It can really unwind.
You mentioned widespread impacts and kind of the breadth of what's going on out there. And just on that topic, tariffs obviously are front and center for everyone here in Canada and along with the US. And I'm just curious, and I know our listeners are too, just how does something like that impact your investment approach?
So tariffs impact the home country most directly. So obviously they're kind of intended to inflict some sort of pain or change in behavior on Canada or Mexico or China or other countries. But of course they impact the home country most directly. It's kind of like a tax on the goods because those goods become more expensive that you're importing. We know markets don't like uncertainty. They don't seem to be loving the indecision that's going on with Trump and the government, the kind of back and forth. It's not great for Canada, and it doesn't seem like it's been that great for the US. It seems like they're trying to kind of bully their allies while not putting the US into a recession at the same time. So, one example, I've heard it estimated that vehicle prices are going to go up something like $4,500 per vehicle as a result of the tariff. So, as you know, a lot of things move back and forth between Mexico, Canada, and the US. You're going to get lots of parts that are being moved across border, then they'll be moved back across to be put into a vehicle, then back across again. So these tariffs make a pretty big impact on that. When you think about something to the tune of $4,500, that's a lot of money. Like the average vehicle cost is $50,000 in the States, so that's almost 10% of the cost of the vehicle. The average income of an American is roughly $60,000, so that's 7.5% of your income. So that's pretty impactful. Why are they doing this then when it impacts them as well as other countries? Well, seems like they're trying to kind of bring some hurt to other countries. But probably the end goal is to bring jobs to the US and try and convince some of these companies to, you're going to open a manufacturing facility in Mexico. Now you're kind of worried you're just going to open it in the US instead, even though the labor costs are more expensive and, land costs might be more expensive and a bunch of other things. They'll just do it anyways to avoid the tariffs or the headache of not knowing what's going to happen. Some of these changes just aren't that easy, right? When you think about globalization's been going on for 20, 30, 40 years, it's hard to unwind. It's expensive to unwind. It tends to be inflationary. So it may make some sense to bring some critical industries back to the US, like semiconductors or steel or vaccine manufacturing. They think, hey, we have to have these in our country. We can't be reliant on China to make a vaccine for us when there's a pandemic. We have to have it on our own. Some of that could make sense where you're willing to pay at kind of any cost. But especially when unemployment's low in the States, it becomes pretty costly to try and bring some of these jobs back. Think about a trip to Canadian Tire or Walmart or dollar stores. Like a lot of that stuff comes straight from China. And if it was made in the US or Canada, it's going to be significantly more expensive. And so what does that mean? It probably means you just buy less stuff. Like you're not, most consumers aren't going to have a whole lot of extra money that just appears. So what are we doing about it? Well, there's a couple different stages. One, watching the industries that are most directly impacted. So I mentioned autos. That's one that, is kind of front and center. Just being careful with those. We generally don't have a lot of auto exposure, so we're avoiding some industries like that. Also avoiding easy targets for governments that are going to put tariffs or countermeasures on. So we've seen these a few times with China over the past several years. And so you never know what the government's going to do. We have a bit of idea what they might try and target. And so, we're not invested in wine companies in the US that export to Canada. We're not invested in U.S. companies that export a bunch of goods to China, where those are kind of perfect targets. Hit U.S. employment and have really no impact. It could be things like premium liquor or something, where it's like, if it gets imported or not, it doesn't really matter to China. No, they don't really care if they get, Tennessee whiskey or something. There's lots of other alternatives. So try and avoid business like that. Agriculture has been one that China's gone after a few times too, so we don't have really any significant exposure to that. So that's that's the kind of direct ones. And we've really tried to monitor that and avoid exposing our clients to that over the past few years. Being a long-term investor is not just trying to avoid risks in the next kind of quarter or two or three. We're trying to avoid risks over the next few years and then benefit from trends over the next 5 or 10 years. So these ones are a little tougher to figure out, right? Because it's the impact of inflation or uncertainty or consumer confidence. And then there's the unintended consequences. We're seeing things like the Chinese company DeepSeek has been in the news lately where, potentially they've found a way to, there may be a little bit of a cheat in there where they might have used some of the US AI to kind of train their own AI, but they may have also found ways to run AI with kind of less power usage or less less server usage, less chip, kind of GPU usage. So sometimes when you try and, cut off exports to a country or really try and hurt them, you end up kind of pushing them to become more innovative and find alternative solutions to this. And so while you think you're kind of hurting them and you are in the short term, you may be helping them in the long term. And the same might be true for something like EVs, electric vehicles. Well, the tariffs are enormous on those, which is why you don't see any in Canada or the US right now, even though there's many out there. They're going to go somewhere. So they're just going to end up being sold to Africa or South Asia or parts of Europe or Eastern Europe. And so they might just end up replacing cars that GM or Ford might have sold to those parts of the world. And so 10 years from now, you may see that, with the Chinese auto industry is powerful and is a huge exporter, and they were kind of more willing to adopt to EVs, whereas some of the US ones kind of push more on old technology like gasoline engines and just were kind of leapfrogged. And now you hit a point where even Canadian or American consumers say, hey, we'd rather have this Chinese EV for 20 grand than buy a domestic one for 50 grand, So those are going to be tough to predict. But for the US, I think the way we're leaning is really the best outcome for them seems to be getting some jobs back to the States, opening a few factories in critical industries like semiconductors, and then taking the tariffs off. You kind of claim victory. We got a bunch of jobs back. We didn't push the US economy into a recession, or try not to, didn't increase inflation too much. And so you can kind of hope to kind of tread that fine line and be able to kind of create some political wins without hurting the economy too much. And so that's what it seems like the path the economy's going down.
Well, certainly citizens of North America are hoping for at least a neutral outcome to this. While tariffs and all of the other policy changes are getting a lot of airtime these days, just picking up something that you just mentioned previously, that, the AI and the related infrastructure boom, that theme continues. So, curious to understand how you and the team are thinking maybe about the medium and longer term impact of those developments rather than kind of what's happening right in the near term.
There's probably three ways that we think about it. One is, is this technology durable? There's a lot of stuff that sounds interesting at the time, of course, and then, 5 years later, it kind of dwindles out and you forget that it was a thing. So we're trying to figure out, one, is AI durable? And it seems like it probably is. These changes seem like they're relatively impactful now, and we can see the path to being more impactful a year from now, 5 years from now, 10 years from now. And so that seems reasonably clear that it's a technology that's here to stay. The second part is just trying to understand the kind of life cycle, because often you get a lot of kind of hype early on, and then people realize, well, it's not quite as ready as people thought. The impact's not going to be or medium term kind of as it is going to be long term. And so then people kind of cool on and say, it's not the time yet, we need to wait. Maybe we spent too much money, put too much capital in this, and then there needs to be some kind of a reset. And we've seen that with other technologies too. Even recently, you think about things like self-driving cars. I mean, there was a lot of hype around those for the past 5 or so years, maybe a bit longer. the timeline was that they'd probably be around now. We'd all be driving self-driving cars right now. And you do see some of them out there in certain jurisdictions, but there's been some roadblocks that have kind of led to slower rollout than some people expected. Same with things like blockchain or Bitcoin. When it first came out, there's a lot of talk about it's just going to change the whole financial system. Everything's going to be running on some sort of blockchain kind of technology. Banks are going to be completely changed. Governments are going to be using this kind of currency, and that could still happen, 5 or 10 or 20 years from now, but seems like people have kind of cooled on that in the short term, and it's kind of more of a tool for speculation now, or black market, kind of black market currency. So that's the question, is just, hey, how long is it going to take AI to kind of really come to fruition? Really long term, it's probably not great for humans. Maybe they'll take over and they'll be our overlords. But before that, it seems like there's a lot of big changes kind of in the pipeline that could make a big difference. Things like, search on steroids that could be kind of impactful for Google or Meta or Amazon reviews. It certainly could take over things like call centers or, prep book publishing, some administrative work. And then kind of medium to longer term, it could take over things like consulting jobs or legal jobs or radiologists, or there's a long list of things that could impact longer out. We're spending a lot of time right now trying to find out who's at risk, kind of who can benefit, and then also trying to find, because as you know, management's a big part of our investment philosophy, and spending much of time understanding management teams and how much value they can add to an investment. So we're also trying to find management teams that could benefit from AI. So the third part, I kind of mentioned three. The third part is, just thinking, is this an attractive investment? You've got the kind of, is it here to stay? When is the impact going to happen? And then the kind of valuation is it an attractive place to invest? And so, you're thinking about past cycles, things like the technology boom in the late 90s or 2000s, where a lot of that stuff was very valuable. They laid a lot of fiber for internet and watching videos and stuff like that. But it took a while for people to kind of use it all. And so those industries went through a real tough time for several years. We might be going through the same thing today, as you're seeing a huge amount of CapEx from the Mag 7 type companies, hundreds of billions of dollars being spent on deploying AI. And so that's the question, is whether that's going to prove to be fruitful over the next 5 years, or whether they're going to have overinvested. So we're thinking about what industries are at risk and who's going to benefit, and how we can make money longer term. And so, we've been leaning on some of those companies, but also some where you're not betting on a certain technology, but more just on the broader theme companies that you've heard many times before, like Amphenol, which is going to be making a lot of the connectors behind the scenes that are going to be used in data centers for GPUs, but are also going to be used in devices that kind of use that AI processing power, like a self-driving car, for example. That's how we're thinking about the long-term impacts.
That's a really great overview. Thanks, Grayson. I think it's a good representation of how we're thinking long-term about this, and trying not to get caught up in what's happening in the moment. But just before we wrap up, we spent a few minutes last time talking about the importance of diversification, just generally speaking, and certainly with the volatility that we've seen lately, it's another good reminder of that importance. How has the portfolio positioning evolved, let's say, in the last 6 months or so?
As you are well aware, we're long-term investors, so our portfolios don't shift too much over a period of a year or two, but we do tweak things on the margin, of course. I'll mention a couple trims and maybe a new portfolio holding. A couple of the trims actually will kind of help to illustrate some of the changes in AI, for example, that we were just talking about. One was a company we used to own called Adobe, that most people are probably familiar with, but they make the Adobe Acrobat Reader that you look at PDFs on. And maybe people less familiar with a business called Photoshop, that is creatives use to edit things like images and videos for things like advertisements, for example. So we sold this because we were seeing a lot of progress of AI being able to kind of develop these images and videos with just simple prompts, And so we saw this being pretty powerful. And while it may not be the kind of thing that a huge multinational company uses for, a Super Bowl ad or kind of a primetime ad, they're probably not going to, chalk it up on an AI kind of quick prompt. And it can be pretty impactful for people running a small business where you have a family business and you don't have the budget to be kind of hiring a big ad agency to be kind of coming up with a new campaign for yourself. So you just want a kind of quick ad to throw onto like a online platform or something to try and get a few more customers in. This will be perfect. It's kind of low cost. It's quick. It's good enough for what you're doing to make it work and accomplish what you're looking for. So we trimmed that, and that's worked out pretty well. It seems like it's been one of those that it's not definitive, but it certainly has seen some pressure in that business on the early stages from AI. A second one that we exited was Cognizant. So this is a consulting company, and they have a lot of offshore workers, IT work that companies might have to really kind of lower cost labor pools. We were worried in the same way that AI could do some of this work for them, where perhaps some kind of simple programming could be done by AI quite quickly rather than kind of sending it offshore to India. In one way, you could argue this could be good for a company like that. Hey, if all of a sudden you can pay AI less money than you'd pay the worker to do it, then you could expand your margins and kind of capture some of that. But our view is that, hey, this is pretty competitive. Consulting is a pretty competitive industry. So it's unlikely that Cognizant is just going to be able to grow their margins substantially. It's more likely that someone else will also offer AI services at just a fraction of the cost that they were offering them, having a person do them before. And so you just get your revenue and cash flow gets squeezed down rapidly at a company like that. So we ended up trimming that one. So those are a couple of ones that we trimmed for risk mitigation on the AI front. The one that we had added that's not related to AI, but is related to some of what's been happening in the economy over the past several months is a company called OSI Systems. So OSI is also owned in our US mid-cap portfolio. And one of the benefits of a firm like Mawer's is that we have the same philosophy and process in all of our strategies. And so we can leverage ideas from other strategies and kind of in a number of portfolios, which is a really nice advantage compared to some others that might have different processes and philosophies and different strategies and may not be able to port those. We're able to do that between our different portfolios, which is quite useful. So this is one that appears in a couple of different portfolios at Mawer. Their primary business is security screening for cargo, airports, and venues. So you think about the one you're probably most familiar with is going through an airport. Of course, you go through screeners when you get on a plane. So they have that business, and they also have the same business for cargo. As you can imagine, as stuff is coming in through the ports, countries want to make sure that there's not dangerous goods coming in. And so OSI makes the hardware and software that they use for these. And so when you think about the world and how it's becoming a little more combative the last several years, and as we continue down this path of deglobalization, countries want to secure their borders and monitor the cargo that comes through. And so the opportunities for a company like OSI Systems are inspecting more cargo. So not everything is inspected right now. And you're also getting aging airports security screening equipment, so that needs to be replaced to update it to kind of newer technology. They have two primary competitors in the industry, but for both of those, this business is a smaller part of their overall business. So oftentimes you see that companies like that are slightly less focused on this because they have just bigger priorities to focus on. And so that's another advantage for a company like OSI is that they don't have a ton of competitors, and some of those competitors might be a little less focused on this opportunity than they might be. That's an interesting new idea that we found that can benefit from some of this volatility we're seeing in the world these days.
That might be a great place to wrap things up, Grayson. Great catching up with you. Really appreciate the time and insights on the portfolio and the markets. And of course, looking forward to the next chance to get to do this again. Thanks again.
Thanks, Andrew.